Hello folks, Steve Lynch here with Discover Options here at Option View Systems. Welcome to this presentation of three different market timing reports for advanced options traders. This will be for Friday, January 12th, getting ready for Monday, the 15th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. We'd appreciate it if you would subscribe. That way you could get alerted when we come out with new videos. And also we have a free ebook for you. It's called Simple Steps to Options Trading Success. Just click the link, give us your info, we'll get that right out to you. We have three reports here for you. For those of you that like to sell premium in a market neutral fashion, the Condor Butterfly Timing Report kicks us off. The S&P 500 Bull Put Spread Timing Report helps those of us that like to sell put premium through credit spreads, but even naked puts as well. But it's predicated on selling puts about a standard deviation away, about 30 days out. And then finally, for the statistically oriented, the directional likelihood report for the S&P 500 answers the question based upon the current market condition: where is the market likely to go? Up, down, wobble around for a bit. We'll get to that at the end. All right, the current market condition that we will apply to all three reports is encountered in three different dimensions: price action, trend, and the stochastic situation. So in terms of price action, we've had two consecutive upswing bars with higher highs and higher lows. This price action occurred while we're in an uptrend above the 50-day simple moving average. And in terms of the stochastics, we are in overbought territory between 70 and 100, all right? And we are above the 3-day simple moving average, or in the world of stochastics, it's called percent D. So this market condition, inclusive of consecutive occurrences, has occurred well over 500 times since January of 2000. So we have a huge population to draw from. Perhaps too much, I don't know, but there's a lot. Okay, so understand that, and that's the market. When we talk about the current market condition, this is what we're talking about. Now, let's go to the first report. This is the Condor Butterfly Timing Report, and of course, all three are for the S&P 500. But since January of 2000, there's been roughly 4,555 daily closes of the SPX. Of those 4,555, almost two-thirds, 65.4%, have been favorable bars for selling premium this way, condors and butters, where the actual 21-bar subsequent movement turns out to have been less than what was being implied by the option prices, the SIBO skew-adjusted VIX. All right, so once again, a favorable bar ends up being one where the market does not move as much as what is being implied by the option prices. The option prices are implying a greater move than what actually happens. That's a good bar to commence with a condor and butterfly. All right, so two-thirds of the bars in the SPX have been favorable bars for doing condors and butters. Now, also during that time, since Jan of 2000, our particular current condition that I just went over has occurred 510 times. That's inclusive of consecutive of occurrences. Now, of those 510, 71.2% of those bars were similarly favorable for option premium selling, like I just described. Similarly favorable. So we have here an edge. 71.2 is higher than the benchmark of two-thirds, 65.4. So we have here an edge then calculated at around 5.8% in terms of option premium selling. So statistically, based upon the history of this condition, it appears more likely than usual that this condition will end up being a favorable one for market neutral option premium selling. Okay? So that's the Condor Butterfly Timing Report. Hopefully that's helpful for those of you that like to do condors and butters. A lot of folks say, well, I'm going to wait for a down day. When vol pops up when implied volatility pops up a little bit. I ran studies on that. In that condition, that does not necessarily play out. You do not necessarily get an edge from that pop in implied volatility. This is from another presentation I did years ago. But just because implied volatility is really low, all right, doesn't mean that it's not going to, it's not statistically a favorable bar for selling premium just because implied volatility low, because, it's more likely that the actualized volatility, what the market really encounters, is going to be lower yet. Okay? 2/3 of the time, like you're seeing. So it is the baseline. Here, prices have been going up and up and up, and in this condition, we still have an edge for the premium sellers. So, just wanted to make that point. Let's go to the bull put spread timing report. Now, again, this is for those that just like to, even if you're going to lean your condors a little long or your butterflies long, and we teach that at Discover Options, how to do that very well. This is really a helpful report in terms of, leaning it bullish. So, as I said, since Jan of 2000, we've had 4,555 daily closes of the SPX. Now, of those, 83.3% have been favorable bars for selling put premium, standard deviation out 30 days away, where the actual 21-bar downside movement was less than what was being implied by the option prices. Now, what I do is I look at the SIBO VIX calculation. I look at their skew published number that looks at the vertical skew, and I combine those to come up with a downside implied movement, which is a higher volatility number than the VIX. All right, so, but 83% of the time, the market does not make it down to that level. Okay, 16.7% of the time, it does go down that level. So that's the benchmark in the terms of the history of the SPX. Now, during that time also, since Jan of 2000, our current condition has occurred 510 times now. Of those 510, 86.7% were similarly favorable, where the market did not go down that far and hit that one standard deviation level. So this implies a selling edge in our current market condition of roughly 3.4%. Okay, so statistically, it's more likely than normal that this market condition will end up being a favorable one for selling out of the money put premium. Okie dokie, so there's that. And finally, the market likelihood report answers the question, based upon our current market condition, is the market likely to go up, down, or wobble around for a bit? And so to answer that question, what we do is we use distribution bands. And let me show you what those look like. Okay, we take the close and we go out of the money to the upside, out of the money. We go above the close, a standard deviation, and this is the upside distribution band. And this is the 5-day band. This is a 1 standard deviation distance 5 days out. And then we take one down underneath the close, 1 standard deviation 5 days out. Now you might notice that the upside is closer than the downside band is from the close. And that's because I'm incorporating the skew value that the SIBO publishes, Chicago Board Options Exchange. Remember, the out-of-the-money call options have a lower implied volatility than the out-of-the-money put options in the S&P 500, right? And so that's reflected here in the distance that these bands are from the close. That way we're getting a more, a view from what the option traders are predicting about that 1 standard deviation level. So we do, and so what we do is we calculate, we just simply monitor for every close here whether the market in the subsequent 5 days goes up and hits the upper band, or whether it goes down and hits the lower band, or whether it wobbles around. And for every close, we note what the market did. Okay? And we keep that calculation not only for the 5-day band, but we do it for the 10-day band and the 15-day band as well. So now we get 3 different time dimensions on price distribution. And when you go to the report, I'm showing you here that of those 4,555 occurrences, the upper band was struck 21.7, the upper 10-day band 16.1, the upper 15-day band 15.3, the lower bands 16.3, 16.5, and 19.3. So those are the benchmark historical distributions of price on the S&Ps since S&P S&P index since Jan of 2000. Okay? Now, when our current market condition occurs, and there's been 282 non-consecutive occurrences, okay, I'm taking the non-consecutive occurrences here for this particular study. Of those 282, the upper band was struck 9.6% of the time of those 282. Now that's lower. Oops, what am I doing? I don't know what just happened. Oh gosh, draw and zoom. No, I don't want to draw and zoom. I want to erase. How can I go back? Well, you know what? Here, let me come back up here. There we go. Let's go here. All right. I'm going to pause the recording and come back just a second. Okay, and we're back. So, you can see that the upper band was struck 9.6% of the time, far less often than the baseline benchmark of 21.7. That distance was 12.1. That's a lot. That's a lot. That upper band is not struck very often when this market condition occurs. The upper 10-day band, only 9.2%. The upper 15, 10.3. All 3 upper bands struck quite dramatically less often than the benchmark. Does it mean that the market's not going to go up? No. It just means that it has gone up far fewer times, okay, than what the benchmark historical distribution is, okay? So we're talking about probabilities and odds here. The market, I mean, look at last week. Same kind of report, market still blasted off. This was for the 5-day band. I mean, that was a 1 time in 10 occurrence. Benchmark, it happens less than half that often. So anyway, let's look at the lower bands. The lower bands are, again, are struck less often than the benchmark, although the 10-day band very much closer. But again, all 6 bands struck less often than the benchmark. This is a picture of lower market volatility in general. Lower market volatility. I can't really lean this bullish or bearish because you're seeing all the bands get struck less often by roughly the same amount, the range. Some of it, like this one, the 5-day bands are far lower. Anyway, let's go now to the situation where if price goes above Friday's high, okay, if that happens, what's the distribution then? Also, what's the distribution been if it exceeds Friday's low? What's the distribution in that situation? That way you can kind of get a helping hand there for Monday's open. So in terms of the market going above Friday's high, that previous bar's high, that's occurred 177 times. You can see here that all 3 upper bands are struck less often by quite a bit. 2 of the lower bands are struck less often, and then this lower 15, strangely, was struck 22% of the time, even more than the benchmark. So that's kind of an outlier there, kind of interesting. But again, 5 of the 6 bands getting struck less often. And in cases where the market goes down below the low of Friday, okay, the upper bands are struck less often still, and the lower bands, even though the market blasted off to the downside, exceed Friday's low, still those lower bands get struck less often. Well, remember, we're in an uptrend, right? Long-term uptrend above the 50-day, so that explains some of that. But I think you folks get the picture. Lower market volatility is most likely in the future here, okay? Wonderful. Thanks so much. I'm Steve Lentz with Discover Options. We'll talk to you next time. Have a great week. Bye-bye.